Okay, let's dive in. Today, we're going to learn how to speak the language of business so you can perform a complete financial health check on pretty much any company out there.
So you see a big headline, right? Company X reports record profits. It sounds amazing, but what does it really mean? Is that company actually healthy? Well, to find out, we have to look past the hype and dive into its financial reports. Think of them like a comprehensive annual checkup for a company. They tell the real story.
And here's our game plan for this checkup. We'll start with the basics, then we'll get a snapshot of where the company stands right now. After that, we'll measure its recent performance, follow the actual cash, dig into the fine print, and finally, see who's making sure it's all legit.
All right, first up, the annual checkup. Let's just ask the basic question. What even is financial reporting? Well, at its core, these reports are the official standardized scorecards. They tell the true story of how a company is doing.
So why do they matter so much? Well, they're not just for the company's own use. They're specifically designed for people on the outside, investors, banks, analysts, so they can make smart decisions. And because everyone follows the same set of rules, it lets you compare apples to apples across different companies.
Now for our first diagnostic tool. It's called the Statement of Financial Position. And the best way to think about it is like a financial X-ray. It captures the company's exact condition at one specific moment in time.
You probably know it by its other name, the balance sheet. It's a simple summary of three things. What a company owns, those are its assets. What it owes, those are its liabilities. And the owner's piece of the pie, that's called equity. And that owner's stake doesn't just sit there. It goes up and down with profits and payouts, and all of that is tracked in a separate report called the Statement of Changes in Equity.
And this all comes down to one core concept. Assets equals liabilities plus equity. It's a really simple but incredibly powerful formula. All it means is that everything a company owns, all of its assets, was paid for in one of two ways, either with borrowed money, which is the liabilities, or with the owner's own money, the equity. It has to balance.
Okay, let's move to the next tool in our checkup. If the balance sheet was a still photograph, our next statement, the Statement of Comprehensive Income, is more like a video. It shows us how the company performed over a whole period of time.
So this is the key difference, right? The balance sheet is a snapshot, showing you where things stood on one specific day, say December 31st. But the income statement is dynamic. It's the video. It covers an entire period, like a quarter or a whole year, to show you how the company did over that stretch of time.
So how does it measure performance? Simple. It adds up all the money the company made, its revenues, and subtracts all the money it spent to make that happen, its expenses. The number at the very bottom is the net income, or what everybody just calls profit. And that profit, that's a huge piece of the Statement of Changes in Equity we mentioned, because it shows how the owner's stake grew. Just to give you a real-world example, our source material mentioned an earnings announcement from Southwest Airlines. They reported a fourth-quarter net income of $520 million. That big number, that profit, comes directly from their income statement. All right, this next piece of the puzzle is critical. We've got to follow the cash. This brings us to the Statement of Cash Flows. You see, profit is one thing, but the actual lifeblood of any business is cash. And that leads to a really interesting question. Can a company that's profitable actually go bankrupt? And the answer, believe it or not, is yes. The Statement of Cash Flows shows us why. It proved that profit on paper, which is really just an accounting number, is not the same thing as having cold hard cash in the bank.
This statement is so useful because it breaks down every dollar that comes in or goes out into three main buckets. Cash from its day-to-day business operations, cash spent on big investments like new equipment, and cash from financing activities like borrowing money or paying back lenders. And this really gets to the heart of why cash is king. Profit is an accounting idea, but cash is reality. A company needs actual cash to pay its employees, its suppliers, and its debts. For any healthy established company, the number one thing you want to see is a strong, positive cash flow coming from its main business operations. That's the engine that fuels everything else.
Okay, so we've looked at the big numbers, but any good diagnosis isn't complete until you read the doctor's detailed notes. In our case, that's where we find the crucial context, in the notes and supplementary information. You cannot skip the notes. Seriously, this is where the company explains the accounting choices it made. For example, how exactly do they count their revenue? Or how quickly do they write down the value of their assets? These kinds of choices can really change the numbers, so you need to understand them to compare companies fairly.
Then there's another great section called Management's Discussion and Analysis, or MD&A. As one of our sources says, this is arguably one of the most useful parts of a company's annual report. Why? Because this is where the leadership team gives you their side of the story, their take on what happened, their outlook for the future, and what risks they're worried about.
Okay, our final step is all about trust. We've gone through all this information, but how do we know any of it is reliable? That is where the audit report comes in. It's the independent verification.
Think of the audit as a mandatory second opinion. Independent accountants come in and comb through the financial reports. Then, they issue a formal opinion on whether the statements are prepared fairly and if the company followed all the accounting rules. It's a huge credibility check.
And what you're really hoping to see is what's called an unqualified or clean opinion. That's the gold standard. It means the independent auditors believe the financial statements are accurate and free from any major errors. That assurance is basically the cornerstone of trust for investors and creditors everywhere.
So there you have it. From the snapshot of the balance sheet to the final stamp of approval from the auditors, you now have the tools to do your own financial health check. You can look past the headlines and see what's really going on with any public company. The only question left is, which company's health are you going to check first?